The Bank for International Settlements is a name you probably haven't heard of, but you should have. It's an international financial institution that can only be described as a behemoth that is literally owned by 63 separate central banks around the world. The Federal Reserve, the European Central Bank, the Russian Central Bank, and even the People's Bank of China. You name a central bank and it probably has its tentacles wrapped up in the ownership of the BIS, as together these central banks control 95% of the GDP of the entire world. They've been dubbed the central bank to the world's central banks, so when they speak, everyone with even half a brain cell listens, and right now they aren't speaking to us, they're screaming at us. A few weeks ago, they put out a seemingly innocuous report as they do every single quarter, but this time around they exposed over $85 trillion of hidden debt that is going unreported by banks and financial institutions all over the globe. You heard me right, by the way, not $85 million, not $85 billion, but $85 trillion of hidden debt. That's almost 4 times the size of the American economy and only 50% away from eclipsing the entire world's economy. Now, I know that no one is going to believe me when I tell them that there's a black hole in the world's balance sheet 20 times larger than the British economy, so what exactly does the report the BIS put out actually say? Well, literally the second sentence on the summary of that report says there are foreign exchange swap positions that point to over $80 trillion of hidden US dollar debt reported off balance sheets. That's how the BIS, a conglomerate of 63 of the largest central banks from around the world, chose to summarize their 86-page document, so I hope it's clear that I really haven't been hyperbolic here at all. In fact, I've actually chosen the smaller of the two numbers, as the BIS are actually referring to US dollar denominated debt as 85 trillion, and when you take into account all the hidden debt denominated in other currencies like the euro or the won, they say there's almost $100 trillion worth of hidden debt. But what exactly is going on? What are foreign exchange swaps? And how is it possible that there is a shadow debt bubble larger than the GDP of the entire world that no one is talking about? Well, it starts with foreign exchange markets and the complications that exist from having to convert between two currencies, which is actually far more difficult than it might at first seem. A foreign exchange swap is an agreement where a party borrows one currency and then lends out in the other currency at the same time and then exchanges those amounts back when the loans expire. This allows two separate parties to essentially swap their currencies around. So if you are a European bank that needs dollars and there's an American bank that needs euros, you can swap your currency and you both get what you need. At the point the loans are returned, the party that started off with dollars ends up with dollars again, and the party that started off with euros ends up with euros again. This is supposedly a great system because you use the current exchange rate for today and you preset the exchange rate you'll use when the loans are returned, so there's no foreign exchange risk from the currencies changing values, and some people will actually claim that this is risk-free lending as a result, which is the absolute worst, most immensely stupid thing you can say because it isn't risk-free at all, but we'll get onto that in a bit. Now, the most important thing about these swaps is that they are not recorded on company balance sheets and they're completely missing in standard debt statistics. Businesses or banks don't have to declare them to their investors, and it's really difficult to find out how much of this debt a specific company has, let alone an entire country. Now, on a normal day, this isn't actually much of a problem because this debt is collateralized by the other currency you've swapped it with, and in the end, once the loans are both repaid, you'll end up with the same currencies anyway, so these liabilities can exist as invisible debt and not impact a company's profitability at all. But there is a problem here, and these debts are absolutely not risk-free. 2022 was an incredibly risky year for almost every investor out there, with almost everyone losing money. Stocks were down, bonds down as well, gold was stagnant, and crypto, well, that fell off a cliff. But even in the worst of times, someone is always making money, so how is the smart money responding to times like these? Well, Morgan Stanley, one of the biggest banks in the world, has identified the one asset in your portfolio that could help you beat the losers that everyone else is stuck with. CNBC have also noticed the global rich making the same moves to hedge against market volatility, but like most elite investment products, only institutions and the ultra wealthy have been able to participate. Thankfully, one group from New York City is unleashing this asset class to the everyday investor. As of right now, they've sold 11 pieces of art for an average net return of 25% to their investors, and this is throughout the crazy market we've seen since the COVID crash, the supply chain crisis, and insane inflation. They're called Masterworks, and since I started using the platform in 2021, they have absolutely exploded, earning tens of millions of dollars for their investors just the last year alone. How does it work? Well, Masterworks buy up an expensive art piece, then they break it up into smaller, affordable shares through the SEC. You can read all of the offering circulars at the SEC database linked in the description. This isn't crypto or an NFT at all, don't worry. This is actual real fine art from guys like Picasso and Banksy. They've performed so well that there's a waitlist to join their platform right now, but the link in the description of this video lets you skip it, so make sure to go and check it out. Now this graph here shows us how much of this debt exists, and as you can see, at this point in time, it has quite literally never been so large. The red bars represent debt that matures in less than 1 year, so will need repaying very shortly. The blue is for debt that will mature within 1 to 5 years, and the yellow for debt that is set for longer than 5 years. This red line going across the graph shows us the percentage of this debt that is due to mature in less than 1 year, and it's currently sitting just below 80%. So what's the issue here? Well, problems start to arise when the global economy starts to stumble and when we have flashpoints or even market crashes, as this causes a funding squeeze and all of this usually harmless debt turns into very bad, harmful debt. Previous flashpoints include the COVID crash of 2020 and the global financial crisis of 2008, where our entire economies fell apart, so it's a good thing we aren't on the precipice of another disaster just like those. Oh wait. Now we are going to see 3 major effects that will cause this $100 trillion debt bubble to explode, and they've actually already started. The first is that this is real debt, and the debt has to have its interest paid, or else no one would be giving out these loans, and this is where we see funding squeezes take place. Now if when all of this debt matures it was simply paid off, there would be no problem, but it isn't. This debt gets rolled over and it just sort of continues to exist, but it has to be refinanced. That means if interest rates have risen since the debt was originally taken out, then the interest payments are going to go up. Now remind me again if interest rates have gone up over the last year. Oh, they have? And at a rate far quicker than the global financial crisis or even the COVID crash? Now you might be starting to see the problem. 80% of this $100 trillion debt bubble needs to be refinanced within 1 year, and the refinancing rates for corporate debt have increased 2, 3, or even 4 times since this debt was actually taken out. Now, just a 1% interest rate increase on $100 trillion of debt will cost $1 trillion every single year, and we've seen the federal funds rate increase to 4.5% right now, which could represent an increased cost of $4.5 trillion every year. So the banks, the institutions, pension funds, hedge funds, or just normal companies which are holding this debt will now find themselves paying far more to service it than they did a year ago, and there's no real way around this fundamental issue. This, right off the bat, will cause some of the weaker companies around the world to run out of money, go bankrupt, default on their debt, and collapse, but that's only the first of 3 problems here. The second problem is that we are entering a recession no matter what Joe Biden tries to tell you. Real incomes have been falling every month, people are making less money, they're spending less money, and the economy is starting to feel it. And you know who else is going to feel it? Corporations. Businesses are going to be earning less money as a result of this recession. They will have lower revenues, lower profits, and weaker balance sheets. So even if their debt service costs had stayed the same, it would already be difficult for many of them to stay solvent, but the debt costs have just increased a number of times over. So we have poorer companies having to spend even more of their now strapped cash just to pay off their debt and stay solvent. Again, this is going to cause some companies to run out of money, go bankrupt, and default on their debt and finally collapse. But again, there is another issue at play here, because this is all predicated on foreign exchange swaps, and what always seems to happen to the US dollar when the global economy enters a recession? Well, the US dollar tends to act as a safe haven and it performs well. As the dot-com bubble collapsed, the US dollar went from being worth 0.9 of a euro to 1.15 at its peak. During the global financial crisis, the US dollar went from being worth half of a pound to 0.7 at its peak. Now, 80 trillion of this $100 trillion black hole is in US dollars, which means US dollars are needed to pay it off. But it comes from countries outside of the US. So if euros, pounds, or yen get hammered along with the European, British, and Japanese economies, then it's going to get more expensive to get a hold of those US dollars. And so again, we'll see these companies run out of money, go bankrupt, default on their debt, and collapse. All of this together means one thing: companies will go out of business because of this debt bubble, employees of these companies will lose their jobs, consumer spending will decrease as people have less cash, and the recession will step up a gear. The swap banks that facilitated these loans will find themselves caught up in the whole ordeal, and a second global financial crisis will emerge, except this time around it will be bigger, harsher, and just worse, because we've seen every financial system in the world flooded with trillions of dollars of liquidity over the last decade. It's likely that countries like the UK, Japan, and Germany will be hardest hit by this black hole, as these economies are very heavily dependent on US dollar investment, and the foreign exchange swap market blowing up would make it nigh on impossible for that to continue, just as we saw during the global financial crisis. As Claudio Boris, the head of the Monetary and Economics Department of the BIS, said, in particular, there is a staggering volume of off-balance sheet dollar debt that is partly hidden, and foreign exchange risk settlement remains stubbornly high. This is coming right from the horse's mouth, from our central bank's central bank. They provided us with the data, they sounded the bell, they've just left us to draw the dots together. And if you want to make sure you never let something as massive as this go by without you noticing, then check out Stoic Markets, my 100% free newsletter where I take topics just like these and expose everything. It's entirely free and you can always unsubscribe. Also, make sure to check out this video's sponsor Masterworks and help support the channel with the link down below in the description.